Work is also pyramid, right? Because the lower level, it is more transactional, more work. Higher level, it is more your mind share, more thought leadership, because you are.
I've always said that you're not calculating the cost of maintaining the person. You're just calculating on the basis, reflecting on the basis of what you are paying us. And then we put up.
How is the CFO doing? He said, dude, I had to get rid of him after 6 months because the guy did not know how to do a cash forecast and cash flow.
Welcome back to part 2 of our conversation with Tanmay and Shridhar on building a startup. We've covered scaling the business. Now let's talk about exiting the business. Whether you're building to sell or to raise capital or just increase long term value, understanding what today's buyers look for and how to prepare yourself, your firm, financially and legally is very important. So let's start off. Which brings me to, I think, the core part of this, which is the whole fractional services part, right? I think in the first part we talked about doesn't make sense to get somebody, especially as senior and experienced as you, full time, because that's not the core for the company. They're not going to need your services all the time, but they are going to need you to make all these decisions once in a quarter, or definitely a couple of times in a year. So, and both of your companies, you're running more than 100 customers. Can you share a little bit about this fractional model, especially in your business? How is it working out, and uh, where are the customers seeing value besides obviously the topics we spoke about?
Yeah, I'll let Tanmay speak and then I will.
Okay. Okay, I think what happens is that, at least in our case, I can tell you, the company that I co-founded, is that when the company gets a new client, think of it as in an IT services company, you have your pod, right? POD pod that we call it, right? Individual vertical, and those vertical again, subdivided in under client partners, right? And those client partners have delivery folks and everything. Now, in this case, the client partners are all, experienced finance guys who not only know basically kind of CFO / senior
Yes,
company buyer.
so you're saying similar to how an IT services team.
Exactly. How like you said. So what happens?
Their services are different. It's finance services, but the structure is really the same. You have an
End of the day, it is IT is also a kind of horizontal services, right? I mean, you do app development for anybody and everybody. You should be able to do it. Similarly, a finance accounting company or a legal company should be able to do that for any company. So these are all horizontal function. But what happens is that in that horizontal function, you create verticalization, and there are certain people are good in manufacturing, certain people are good in IT services, some people are good in technology SaaS, and you create that. Now, when you get a client, you basically push the client based on the vertical in that vertical, and then they give a client partner, senior accountant, junior accountant. So there is a whole team gets created. The only difference between an IT services and this is that in IT services, you are billing full time to your client. So one person is working for one client full time. Here, this team possibly is working for 4 or 5 clients, right? Why it is happened? Now, let me tell you from the basic accounting the bookkeeping perspective, like AP. Now, you are getting a client where maybe that company has 50 bills to enter in a month, or maybe 20 invoices to enter, AP invoices to enter in a week. How much time does it take, right, from contract to entering date, entering the invoice? So you really don't need a full-time person on AP. I'm not even getting up, right? I mean, getting going later. I'm just saying the basic thing that you are doing there itself, you don't need always. So, and it's the way the industry is also, the stuffing is also pyramid. Work is also pyramid, right? Because the lower level, it is more transactional, more work. Higher level, it is more your mind share, more thought leadership, because you are getting certain data, you are reviewing that data. You are not creating that data, but you are reviewing that data, getting meaning of that data, and disseminating that meaning to your CEO and your board and everything. So that's why, for smaller companies, full-time in my view at least, it's like, it's very easy to manage, 4-5 clients for one team, or for one, CFO, or for one senior controller. But, it also happens, right? One of the clients starts becoming big. Then what do you do? So then, you have to, after beyond a certain level, you have to start saying that, okay, maybe I need to keep, 1%, 2% full time for this client. And that way, if the client is becoming a, say, $100 million IT services company, then you create a complete team for that client. Unless the client wants its own internal team, right? That's a different thing. Just say, assuming that the company outsource.
The customer is actually using a whole pot from
Will pot for the thing, right? The way that IT services happen. So that's the thing.
yes.
So that way you basically create the whole, function. But the important thing is that one has to remember that, and I'm sure it is true for Shridhar also, these companies are not into a 1-800 number company. Like, you call Priceline, customer service. Today you are calling, even IRS, right, in US. You are calling today, I am Emily, tomorrow it will be Hector. Day after tomorrow it will be George. For here, everybody is named. And you are seeing them, as a person, in flesh.
Actually, to some extent, that's exactly what Shridhar was talking about earlier.
Exactly. So that's the big difference, right? So these people are your accountant, these people are your customer service, these people are your, and same thing with legal, right? They do everything.
In the chat GPT world, it's the context, right? You can't lose the context.
Exactly.
These individuals keep the context going.
Exactly.
You see the similar model for you, I suppose.
Yeah, similar model, and I can give a variation of it a little bit, and I have a few questions for Tanmoy as well in that process. Yes, when it is small, the fractional part does work out. See, these are specialized services, not that others are not, but these are specialized services. And when it is special, then it is only transactional, or it will be required only when it is required. Leave aside the compliance part, which is ongoing, as I mentioned a while ago. But when we are talking about specialized services, then you would need them occasionally. So therefore, do you need a person all the time in front of you? Do you need a legal person all the time in front of you is the question to ask. And I'll come to that when it is required. Right, Tanmay? Same case probably when the...
Not at all. I mean, not at all. So the point is that, what happens, at least what I have seen, right? There are a lot of templatizations happen over a period of time, correct? Even stock option, there are small, just started, don't have money, no funding, started. So, you'll come to me and say that, hey, maybe a friend of mine, right? I mean, not even client, nothing. Hey, I have to give some stock option. Do you have? So I have templates. So I will give it to them. But then I'll tell him that, dude, before you raise your first funding, please show all these things to a lawyer. Get that person, review. Get that review.
Yeah.
Don't, this is a template. But what happens is that there are like, vendor agreement template, customer agreement templates. There are a lot of templatization happens over a period of time. And it's not that it's happening with the client, it's happening with us. And that's why, there are a large level, you don't need someone full time. That's why I was trying to tell you, in my experience, a venture funded company, till Series B, even sometimes till Series C, they don't need anyone, full time inside the company. In fact, my view is that many a time they have to take, the CEO has to take because the investor asked them to take. That, no, this is the time now, you should take it. Otherwise, maybe some of the CEOs will tell me that, dude, I don't see that why I have to take, but yeah, I have to spend this money, right? That's so I think, Shridhar, unless every person has a full-time work in the company, in that particular company, why would you take it? Because you are not paying a full-time salary then if you are outsourcing it, right? Question is that when that trigger point happens, that's the most important thing. Now that trigger point will happen when you see that your outsource agents are start, failing or, dropping the ball, and you see that, they're actually started dropping the balls not because of competence, but because of volume. Then you know that, okay, what should I do? So that's the trigger point in my view.
So what I was saying is, in our journey, we have seen that while we are fractional, we are, you can say for that matter, part time. But eventually, as the operations increase, we ourselves have interviewed, scanned, reviewed resources for our client, help them place them at the client's place, did a hand holding for about 6 months, and thereafter the client comes to us. We're still engaged with them, but they come to us only for strategic things, routine things, because we have the person has got trained under us. Uh, that person always has a outreach to us. He can always reach out to us, but the routine things are taken care of at the in source level, and strategic things come to us. So this is also something that, as a model, we have been helping our clients over a period of time.
Yeah, I think there are so many similarities to the IT services model, and both of you have been serving IT service companies, so you probably understand it better than I do. But the first part is templatization. As a customer, I need XYZ, an AOP or a NBA. You have it ready. You just need to put in the company name and send it. Right. The second part is you have all the skill levels, right, from an accountant or a paralegal to somebody who's a chief legal officer or CFO. So obviously we can't afford, there is no need to have somebody full time, but if I need an hour of a CFO's advice, that's available. So that's number two. I think third part is the ability to look at the journey and plan for it and give us advice over 3, 4, 5, 6 years, because you're seeing where the market is. You have experience from another 100 customers who are probably trying to get funding, who are trying to exit. So you can tell us, look, this is the trend in the market. This is what you need to do over the next 6 months, 1 year, to be able to succeed, at least in the short term. So those things are significant value, at least how I see both your models.
Yeah, and one more important point, Sameer, is because these are specialized services, the people are in great demand, and because they are in great demand, which they are aware of, they have a value and a demand in the market. They will always look for how they will be able to enhance their value. I'm talking about the legal resource in this particular sense, and I'll put this question to Tanmoy as well. Is, if suppose the company is small, and if you still are able to afford the cost of that specialized person, how will you keep that person interested, motivated for a long time if the volume is less? Whether you are able to give him value or not.
Absolutely.
There is not enough to do, and therefore there is a lot of churn. And then that turnover keeps on increasing the cost. Cost of, not from money point of view, but from operations, knowledge transfer, handling the clients, handling the situations, and so on and so forth. That is one continuity that the fractional model gives to the client, as that I know what Sameer wants. I can percolate that to my team. Right, Tanmay? How have
Oh, absolutely. So, one of the big solution or USP you can say in the fractional thing is that the company doesn't need to worry about the next CFO or next controller or next accountant or next legal guy. If one is leaving, another is coming, right? I mean, that is the responsibility of the service provider that's happening. So you can concentrate your core business, your development, your service provision, your sales, continuously. The rest, this back end, these things can happen. The second thing also, I will tell you that sometimes some companies, I'll give you a very interesting example, I mean a real life example, that sometimes people also in a startup, people will bring, for whatever reason, right, full-time folks and all those. And we had a client, the CEO and I worked together in the year 2011. We sold the company. I left, he left. Sometime in 2016, he came back and said that, hey, I have started a new company. I want you to, your service, your company service. I said, okay. So there was again a pod, used to work for him and all those things. Then he comes and says that, hey, after a few years, sometime I think in 2020, just before I think COVID or something, or maybe during COVID, he comes back and says that, yeah, this guy, the investor wants me to take this guy as a VP finance full time. So, I want you to, interview this guy and tell me that whether he's the right guy. Or maybe, basically, the investors want him to come as a CFO.
Yes.
So I interviewed him, as Shridhar is saying that we interview, we handled. So I interviewed him. I went back and told that, hey, he's not a CFO material, but he's a VP finance material, and he should learn it because your business is a very, very different business model. It's somewhat, platform, somewhat services, and there is a social angle, etc., etc. It's a very interesting business. He said, yes, I think that's the thing. And then after 4 months, the guy comes and says that, I want to have my own team. I can't have a outsourced guys.
Outsourced function.
Outsourced.
So his boss is outsourced, his team is outsourced. What is it?
Yeah, he says that I cannot manage this, that.
Huh.
So we left, obviously. Our contract was terminated. He took, internal people, and then we didn't have any relation with the CEO, with that company. I had a call with, the CEO just 3 days back. And I said that, hey, what's happening? I just saw that you are also not there in the company, etc. and all those things. So he said that, dude, what happened was that Silicon Valley Bank gave us a very big line of credit, and Silicon Valley Bank went bust, and it was such assortic, it's not a standard line of credit. It was such, as our business model. And nobody else gave. And, we had to then depend on other source of finance. So, it didn't become that interested. So I got a new CEO, and, he's a very young guy. I mean, when I met him in 2011, he was 29 years old. He was a CEO. So I said, okay, so how is the CFO doing? He said, dude, I had to get rid of him after 6 months because the guy did not know how to do a cash forecast and cash flow. He was doing it based on the financial model that you guys did, and he didn't even check the actual cash balance. So one fine morning, he's calling me and he's saying there is a $2 million difference. So, what I'm trying to say, what Shridhar is saying, I'm just saying that, that happens also sometimes if, you are not going through the whole, because every business model is different, right? Even if it's a SaaS, in SaaS also there are tweaking. Even in IT services, there is, you have a T&M, you have fixed price, you have fixed monthly billing and all those things. If you don't know everything, it's a big problem. So that's the thing.
Yeah, I think there are model uniquenesses, and if a company has been built ground up with a certain model, unless you understand that model, I think the customer has a risk. Bringing in new team members is good. Insourcing is good, as long as they transition it enough and the new team learns it enough, right? So, I think the fractional model works very well. At least I have seen it for the last 3-4 companies. And, in one of the earlier companies, Shridhar, we had exactly the same situation. We actually we made an offer to a CFO, which was 25% higher than his salary. He liked it and he said, look, I don't mind coming in, but I know your financials. First of all, you're putting in too much money for my role. Maybe you can hire somebody who's more core. And secondly, there is just not enough for me to come in right now. So, so you're right. I think sometimes we try to overinvest, but that is not required. So
that brings also one more, I think the last point on this aspect is that many times clients at the end of the year say, oh, okay, we have paid you this much for the whole year. In this cost, I would get a person of my own. Then my argument has always been, and of course selectively depending upon what the company is and where it is, I've always said that you're not calculating the cost of maintaining the person. You're just calculating on the basis, reflecting on the basis of what you are paying us. And then we put up various parameters and contours to it, saying that will you get expertise on ABCD matters? And if not, then you again come to me. And then you pay that guy as well and you pay me as well. So we have been able to, while we have helped clients get people in-house when we see that there is a reason for it, we have also asked clients not to do it. And we have said that if you think you're paying us much more, then you can go to another lawyer, but don't get a person in-house, because it will only increase the cost of maintaining that resource, because at that point in time, that's not the requirement. So in the interest of the client.
So these fractional CFO and legal services are exceptionally important, at least till you get to a certain level where you can afford to have your own team. And that comes far down the line, maybe 5-6 years, right? Unless, you scale or you get to that hockey stick very early. But let's kind of move forward, and the last stage of a company, right, where the founders now have built the company, they are happy with where they are, and they are getting multiple offers. There is VCs in the play, not VCs, private equity firms, the other similar companies who want to buy you either for the IP or the service. Uh, just very quick summary of what would they be looking for. If you were one of those buyers, what would be the 5, 8, 9 checkpoint items you would look for that a founder should be aware of, so they know from day one I need to make sure these are taken care of.
Mhm. Yeah. 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 Tanmay, please.
I can go and then Sridhar you can add. Yeah.
Yeah. Sure.
I think it's a, in my view, at least what I've seen or what I feel is that different verticals have a different way of looking at these such exits, right? Let me tell you about IT services, because in India it's one of the most important sector. What I see, at least in US and I'm sure in India also, IT services need to make money, as simple as that. I mean, their EBITDA should be high enough.
Isn't that true for all businesses? Actually, you're right.
May or may not be. That's why I will come to other businesses also, right? IT services should have, decent growth. We call it, rule of 40. Nowadays, they have started doing rule of 70 also, but, I will keep myself at 40. Rule of 40 is that your revenue growth percentage plus your EBITDA percentage should equal to 40. So if you are doing an EBITDA of 20%, 20% growth is 40, you can command a good price.
If growth is 55, my EBITDA can be minus 60.
Yeah. Technically, yes. Whether some of the investors will like it or not, that's a different thing. But yes, it's a rule of 40. Question is that, if you are actually growing 55% in an IT services, you cannot make a loss. As simple as that. But, we can discuss it. Second, I think also is that in IT services, what I've seen is that it was definitely to a significant extent that what kind of business you are doing. Like, are you a staffing agency? Are you a project agency? What skill set, data analytics, AI currently is ruling the roost, and etc. etc. So that's the, and there are other issues, but I'm just keeping it at a 5,000 feet.
Growth, profitability, quality of revenue, type of
concentration of customer, that also becomes an important thing. But I'm just saying these are the 3-4 main items. There are other ancillary items.
So these are above the line items, and then below the line items they will basically look for basic hygiene, right? Like
correct. That's what I'm saying. There will be other items, but but your main valuation will happen based on these 3-4 items, right? Rest are valuation will go up by 5%, go down by 10%, and all those things. When it comes to technology and SaaS, there the exit is interesting. There actually, what is happening? Why do you IT services generally don't need to take a large amount of funding because it creates its own cash. Whereas in technology, you need to have a lot of funding because your R&D development cost is very high. That's that's the thing.
Okay.
So there are mainly what I've seen is the 2 things or 3 things. What is your state of your product? Whether it is something out of the world or it is inside the world or it is very much comparable to other 5 products in the market. What is your sales growth, revenue growth, and churn of your
growth will come back to that same 70 equation, right?
Yeah. So those but if there is a hockey stick growth, if your product is good, if your there is a path to a break even if you are making loss, which in SaaS I have seen which vertical you are in. You are in energy, you are in pure technology, you are in social media, so those also become extremely important, whether you are a B2B or B2C. So those are the very, very important things start happening, right? So what I'm trying to say, there are two different things. Similarly, in manufacturing, there are other things that how do you are making your how fast you are, what's your inventory turnover, how fast you are turning around your inventory. That's very important. How you're managing cash, right? Again, manufacturing also would like you to make money out of it. So different areas, different verticals have a different metrics, which helpful for exit.
Sameer, so I agree because Tanmay is looking it from the valuation point of view, and I would look it from as a lawyer. I would look it from the diligence point of view, and what we have seen is that the investors would always look at transparency and not perfection, because it's not possible to get a perfection on everything. What I mean to say is that if you have
Maybe you can elaborate that with an example, right? Or maybe
Yeah.
actually.
Yes. So I can give you an example of how this works or this happens most of the times. I would say that the Indian, I look at it from an Indian setup point of view, and the founders would be traveling to say maybe US for some business, and someone says that, no, why don't you have a company in US? It will help you from all aspects, presence, market presence, everything. And it's easy to incorporate a company in the US online. He's there for 15 days. In 2 days, company is incorporated. He pays by credit card for the capital, and he comes to India. And there is no issue at all. No one knows that he's incorporated a company outside India except for the tax authorities probably. And then there is a diligence, and then the investor lawyers come and say, okay, how did you incorporate this company? And he says, I paid by credit card. Now, this is not possible. This is not within the construct of Indian laws. And then the whole story starts, because he would have spent almost 3 to 4 years running that company. And we have actually handled these situations.
But it's a credit card. Even after the credit card is paid, as in I can understand why.
No, that's not the right way of routing money outside India. So let's keep that compliance part aside. It's overcomplicated. So the point of matter is, who will come to know? If suppose there is no business in the US entity for some reason, and the founders ask us, who will come to know about it? I said the lawyers will come to know about it the first thing, because he said there is no money moved out of the company's books, so there is no way the finance people will be able to catch it up in diligence. There is no way there is any returns filed, because there is no compliance done, and so on and so forth. So how will it come to know? But it doesn't work that way, because somewhere or the other you would have done some kind of a transaction. Some customer would have paid your US entity. You would have got that money from the US entity and India entity, and some way this gets into the picture. So what I'm trying to say is that the structure has to be clean. If for some reason, for unintended mistakes, if that has left, be upfront and tell that this is what has happened, and disclose that, and there are ways and means to overcome.
I think Tanmay had a similar example in one of his earlier M&As. We talked about it last time, Tanmay.
So what all I'm saying is that bring it to the fore, and there are ways and means of getting ready for it. Is even before you think that you are wanting to approach any of these liquidity event contributories, maybe M&A, VC, private equity investors, whatever, do a diligence of your own. We typically call it as a vendor due diligence or a inside diligence. You do it, be ready, and if the diligence brings out any adversaries, make it upfront, because it's
almost like an internal audit, right? Before you go to external audit, if you do an internal audit, just to make sure that you are as
yeah. So just that, do it with external folks, even if it is internal audit. So that there is
these are folks that are part of your team, so they won't flag it to the SEC or whatever in the case of financial audit. But yeah.
And see, if it is grave, it is grave. It will any which ways come to the fore. There are certain things which are good to have things. Of course, not compliance matters. Compliance matters are must to have. But still, there is a possibility that it can be overcome over a period of time with some small penalty, and so on and so forth. Bring it to the fore. Keep it ready. Tell them that this is what it is, and the value of that, the penalty of that, will not hit your valuation to a higher rate. So that's what I'm trying to say, is that the investors will not be wary about this imperfection, but the transparency is of utmost importance.
Yeah, I think the transparency builds some level of trust also, that you've done the right things, or at least you talk. I think you also answered that readiness for sale topic, which is, let us say a founder is ready to get his company sold, there is a readiness. I think one obvious thing that you talked about is the internal audit, or audit with experts like you, so you can look at the books, you can look at the legal agreements, compliance, and call out any red lights that need to be fixed, right? So how long do you think that period typically is? What's your experience? And maybe some things I get caught up as you talked about the entity. I think Tanmay has a few interesting examples as well.
Yeah, so if you remember, I had said in the last conversation that if you are ready from day one, then you are able to create a data room for yourself. So to answer this question, if your data room is ready, then it's just about sharing a link with your due diligence partners, and depending upon the volume, and of course, but around, you can say, about 6 to 7 weeks, if all the data is available, with counter questions, questions on questions, answers on the questions, and questions on the answers taken together back and forth, depending of course upon the volume, you should be able to complete this within about 6 to 8 weeks time. And
Isn't that very aggressive? I would think this should be at least a 6 to 9 month exercise, because you have to fix the books, you have to maybe, I don't know. I thought this would be 6 to 9 month period, but maybe I'm
yeah, so 6 to 8 weeks is to find out what are the problems, not to fix the problems.
okay.
Yeah, so
So you put all the documents in the data room, and here you open it to Tanmay and Shridhar, and then your team will go through them and come back and say, hey, there are these 11 gotchas that you need to fix. Otherwise, that's going to either just not help you sell, or if you sell, your valuation is not going to be where you want it to be. Is that what you're saying?
yes.
Okay. Tanmay, you have a lot of experience doing this also.
Yeah, actually, I mean, I feel, or what I have done in my life everywhere, right? I mean, right from Patni, everything, is that I always tell my team, like my finance team, that assume that tomorrow the company will be sold. So all your, documents and all your, I mean, right from documents, right from financials, right from tax return, right from incorporation information, right from all the minutes, everything should be, properly folded, properly directory, year wise, etc. What is a company's, shelf life, right? Company shelf life is 5, 7, 10, maybe 12 years, 15 years. If we can create, and I don't think that, beyond 3 years, 4 years, any buyer goes before that. I've not seen, at least. So if we can have that kind of paranoia in ourselves, and if we can keep it for 3-4 years, I think that itself gives us. Now, I agree with Shridhar on one thing, is that definitely that before you go out to the market, you should look inside, and you should say that, okay, I have everything, but what are the 5 things or 10 things that are issues? So you do a quote unquote audit or internal audit, and then if there are issues, obviously you take care of that. I mean, one issue I'll tell you guys, always we have seen, is that when the company goes into large acquisition is happening, suppose, I mean, always the first question is asked by the buyer or prospective buyer is that, why there is no stock option compensation entry in your books? Now, stock option compensation entry is a Black-Scholes model and all those things. It's a fairly complicated, calculation. And generally you don't do it, because, you are basically saying that, okay, it's end of the day, it's a non-cash entry. Why do I care? I mean, if I am getting audited, I will do it. Otherwise, why should I spend money and spend energy to do that?
Correct.
But the reality is that, if you are into Series B, Series C, or you are, $100 million or $50 million even is a valuation happening, someone may ask you that question. And if you say that, I mean, one is that you say that, why do I need it? But, other thing is that, okay, you before you go out, you say that, okay, let me do that entry, let me make one entry and, go that, right? Another example is deferred tax in US. India deferred tax calculation is slightly easier. US is a little bit more complex. You don't do it. You say that, okay, end of the day, here I'm paying the tax, or for loss-making companies, I don't even need to pay the tax. So the point is that it just moves on. But there are people, mainly, I have seen a lot of times these companies, these buyers come with PwCs, they bring KPMGs of the world, and they will specifically ask these questions. So these becomes very, very important. I'm just giving examples like that. There are compliance issues there.
I mean, they have to go do their diligence, and a PwC or a Deloitte or whoever it is also has to justify why they are doing it, right?
Why they are doing it, exactly.
Because where the challenges are, they do this for a living. So I think your approach is be proactive right from day one, or whatever, first year, second year. Make sure this is the goal. Have readiness that you are going to have to be audited at some point of time. Make sure you're doing the right things. That reduces your, in technology terms, you would call it tech debt, right? Or backlog.
Correct.
And then eventually, anyway, when you made up your mind, you create a room, a data room, get the auditors. But hopefully by that time, if you do it, you won't have so many items to catch up. I think that's
the main point. And I agree with Shridhar that once if you have those things, then you just give the access of your data room to those guys, right? It's so easy to do it. So, but yeah, that's the thing. That's the way I always have taken this work.
Yeah. So the final and exciting part is, let's say if a company is being made an offer, or I think once the data room has been open to possible buyers, what's that negotiation like? This is like a 2-month, 3-month cycle. What are the typical terms or variables in those terms that one has to watch out for? And if it's too broad a question, maybe you can put certain.
Yeah. So it is a broader question because we have dealt with one deal where the negotiations went for almost about 13 to 14 months, if I'm not wrong. Of course, there was a liner to it because COVID came in between, but the deal was back on table after 14 months, and then it happened in the next 6 months. But we have seen, and this is a evolving process, to be honest, and most of the times it is between the principals as to what value I believe I should give and what value the seller wants to take. But it's anywhere between, on an average, between 2 to 3 months conversation, and a very intense conversation that we have seen on an average. Outliers are always outliers. So that's where we think it goes. But again, it depends upon people to people. So there cannot be a one rule for everything. And the other thing that you said was about what are the top 3 for me things.
3 or 5 things that the
3 or 5 things that
one, of course,
the
besides
correct. So the founder should look at is what is the value, of course, but how is it going to be paid? Whether it is upfront, whether it is over a period of time, whether it is earn-out. If it is earn-out, then what conditions, and so on and so forth. Second is, what is going to be my role as a founder after you get in, right? Because and especially when there are earn-outs. If I do not have the autonomy of running my business in the way I have run it to fetch that earn-out, then it's like giving something not to give. The third thing I would look at is, what am I agreeing in the agreement with respect to my liabilities over the past, or for the past actions and for the future actions. And the fourth thing, and I'll restrict to that, is what are the matters on which I would have a veto. Is something which is very important. At a broader level, these are the 4 things that I would look at, or I would advise the founder to look at, and I would fight for him for these matters in a reasonable manner, so that value is given in the manner in which it is demonstrated to be given in a deal.
Outstanding. This is beautiful insight. Tanmoy, I'm sure you have.
Similar thing. See, the point is, you talked about how long does it take generally, right? You would always like to keep it as tight, the process as tight as possible, and the timing as less as possible. That should be, your goal. Because what happens is that if you keep the process long enough, there are always business cycle when you are suddenly for 2 months you did not do well, and that will become an issue. So you always like to keep everything tight and very much under your control. number one. So once you get a LOI, and I would say that before you get an LOI, you should have a very clear understanding that what all they are asking and what all you are giving to get an LOI. Because you don't need to give everything to your of your company to give them an LOI. They should check 2, 3, 4, 5, 6 areas, and they should do it. And then there can be due diligence, legal due diligence, financial due diligence, HR due diligence, technology due diligence, and all those. Once the LOI is accepted, and there the LOI asks you that is very important. What is the value?
First is you give specimens or core data, of course, on the balance sheet and stuff, right?
Exactly. And not only that, they will check out your product, and they will check out your services, they will check out your skill set and all. But that should be a very basic stuff. Based on that, they should be able to give you LOI. And that LOI, what Shridhar said is very, very completely agree there. What is the value? How the value will be paid? What is the escrow amount? How much is indemnity you are giving? And all those things. I mean, in fact, personally, if you ask me, I will be okay with a lower valuation if I get the money upfront.
Correct.
Rather than, because, you can try to, exert your influence after the sale. But the reality is that if your buyer is a large company, not much will be under your control other than this very specific area where you have been, you will be working in. So if there are a lot of, earnout, that is always a worrisome. And if the buyer is trying to integrate you fully, if they keep you as a subsidiary, separate, and all certain things are good. So those are the different things you should look at. But once
I
they
think it depends on what your aspiration also is, right? Do you want to continue to be aligned to the business and run it?
Exactly, or not,
Or do
right?
you want to move on and do the next big thing?
Correct. The other, once the LOI is signed, I think the very important thing is, how fast you can finish, right? It should not be more than 60 to 90 days. Now, you should try with 30 days. You will never get 30 days. They will talk about 90 to 120 days. You said, okay, you end it as 60 days with saying that another 15 days, grace period, something like that. You have to negotiate those things because you need to close it. Because once the LOI is signed, it's not that only your employees, but most importantly, humans are very, very, we love to gossip. So things start going out. You don't want
You can't keep it under the wraps for a very long time.
Exactly. So those are the things. That's why also, other than closing the deal, these are also important, right? So those are and that's why also it is very important that your documentations are very much in order, so that it happens very smoothly, all the due diligence.
No, this is great. I think you shared a lot more than would have been possible for somebody to get from you in a 1-hour meeting. So thank you for being able to share your experience and knowledge. I think this has been a fantastic conversation, Tanmay.
Thank you.
What a fantastic wrap up to this masterclass in startup growth and readiness for exit. Remember, Wai is your product engineering partner to build scalable and modern SaaS platforms. You can contact us at reach@wain.com. If you are planning to scale or sell, this episode should stay bookmarked for every founder. All of you, if you need to reach out to Tanmay for CFO support, fractional CFO services, you can send a note to www.ArightCo.com. For those of you who are looking for help on legal services, mergers, acquisition prep, compliance, you can reach out to Shridhar. His company's name is www.LegaLogic.com. So if you like what you heard, subscribe to Wai Involve, share this with your network, and join our growing LinkedIn community. Thank you, and see you again soon on our next episode.